Again, we're going to talk about capital calls, the good, the bad, and things that you need to know. Again, want to make sure that we're clear. This webinar is for educational purposes only. We are not financial advisors. We're not accountants. We're not advising you what to do on your specific deals. Our goal is to share what we know about what happens and then have you be able to make some educated decisions based on what we're sharing. And obviously every deal is different. Every situation is different. So here's our agenda. We're going to talk a little bit about massive capital. I know a lot of you know who we are. We're going to talk about things to know. We're going to do a quick case study, and then we're going to open it up for Q&A. And again, our goal is to do our best to provide rounded educational material that you can use to make your decisions. So this is our massive capital team. So up in the top left, you see Sanjay, Shirar, and Mike, who are with us tonight. They're the key principals on massive capital. And then you can see our team keeps growing. We have a couple of grayed out areas. So if you know a good candidate, we're looking for those couple positions. But we have our investor relations team. We have acquisitions managers, underwriters. Jonathan, who's going to speak a little bit tonight, is legal counsel. We have Angela, who keeps us all in order. And then Senate, who's taking care of our educational program, which we've been doing a lot of updates and revisions. And we're going to share some exciting things in the next few weeks about some things that we've learned just in starting our program and ways that we can make it better for people to get educated and to be able to get to the next level in their investing career. So massive capital, we basically have all different types of assets that we do. So land banking, land packages, land development, development, building operations, building renovations, property redevelopment. So we have a whole series of things that we're involved in. We have a series of core assets and some different deals. So if you look back at our deals, we've been doing obviously value add multifamily. That is the original bread and butter of what we do, but we've added to that. So we've just completed a land entitlement deal in Georgetown, which is just north of Austin. And then we're going to do phase 2 on that, which is where we're going to, assuming it's us, we're going to go vertical with that. You've heard a couple of times us talk about X-Space. X-Space is on the development side. And so be sure to reach out to anybody. We'll put a link in there so you can find out more about it. It is a 506C. These are areas that we're focused on: North Carolina, Georgia, Florida, Houston, Dallas, San Antonio, Denver, and the Phoenix market. We do this a lot with partnerships, strategic partnerships. So we actually did our last Dallas deal with folks who live in Phoenix. Well, what does that do? That opens up the Phoenix market for us. We have one property in Denver. Can't specifically talk about the other, but we are working on one because it's a 506B. So if Denver's a market that you're interested in, then you would reach out to somebody on massive capital that you have an established relationship with. So we have a lot of exciting things happening. And the goal is that we provide lots of education, lots of investment opportunities, and that we help you diversify your investment opportunities. So we're on our 4th deal this year, and it's just June. It's not even June. Tomorrow's June. So it's pretty exciting. You want to go?
Sounds good, Trevor.
Yep.
I'll take it from here. So,
awesome.
Thank you. Trevor, appreciate the feedback, and thank you everybody for joining tonight. And again, our goal is to look at the whole concept of a capital call very objectively, or I would say academically. We're not going to take a position, good or bad. We'll just try to take a look at what is the capital call, how typically we get into a capital call, or one gets into the capital call, and both from the GP side and from the LP side. But then we'll focus on the case study on the LP side, some of the ways that you could take a look at it, and then you can reflect on yours and see which way it goes, right? The whole idea is that it should not be a taboo concept. It should be a concept that you talk about it. And from that perspective, if you go back and take a look at it, folks who are doing many deals, and folks are doing, the good folks are doing many deals. And when you do many deals, you make choices, and sometimes thing happens, right? So we'll try to share you a little bit more how to polarize or how to separate the goods versus the bads, and then I'll give you all the information or most good chunk of information where you can decide. Right? So okay. So just to give you some data points for us, again, we're not attorneys, we're not accountants. Whatever we talk about from our own reflections. And the same thing here. We don't want to talk about just the capital call. We want to give you the information from our own experiences, right? As you know, our team is heavy. So we'll give you, I thought it's a fair data point for us to share. So as GP, since the massive capital started last year, we have done 7 deals, fixed 5, fixed an interest rate with 1 variable, had a rate cap at 6. That's going to run till Q2 2024. When we started, we had that at 3.9 at the data point. As a team, beyond the massive capital, before we started massive capital, since Q1 last year, we have done 13 plus deal, and all of them has a fixed interest rate. In other words, our portfolio perspective, all of them have a fixed interest rate till one that expires in Q2 2024. Beyond that, everything is a fix. So that's the way we went about it last year, and that paying us dividend, even though that put us in a corner where we are thinking a little bit different than the market, had to buy a smaller project, but it worked out. All of our portfolio is cash flowing. And LP dividends, we have all but 2 that we did not pay out the dividends. One is going through, which is the McCollum. We're going through the business plan. It's going to come due next year, and we are on pace for that one. Second one is the Pasadena assets. We paid 1 dividend and we held back the rest because it had back-to-back couple of hits. We trying to make sure that we are in a very good spot as we kind of go through. So that's that. And as an LP, since 2017, not 201, that was a typo. Massive capital team as a whole, we have done 40 LP deals. We have seen 10 plus, about 13 or 14 deals that stop paying dividends. Again, those are somebody else's deals that we participated as a team. And we had cash call for 4 deals, and our team, or one of our team members, had lost money into 1. So we have, in other way, when we look at it, we have numbers and understandings over 40 active deals that we are in it. And our reflection comes from there. Then we add a layer of the academic view, right? And again, as I go through, please start thinking about the questions that you may happen, and just let us know, and we'll take a pause and answer those questions as we go. Okay. So before we get into capital call, I thought I will share something. I worked at Shell for a little over a decade, and Shell was one of the dividend aristocrats, right? For 70 plus odd years, we paid dividend out. And we remember until 2019, 2020, when the oil and gas price took a major hit, that was a big debate, whether we stop the dividends or not. We cut the dividends or not. It was a big taboo. Happened to be, I was working in the upstream, had access to the CFO -1, and we saw them, how they struggled. It was a big deal. Then Jessica came about and she made the call that we're going to cut the dividend, right? With the right intention in mind. So the point is, one of the Fortune 5 companies will get into the same scenarios where cash is an issue, where they want to hold off the cash to weather out the downside, just in case something were to happen, and then come out and make it up as we go. This is so again, my point is that good thing happens to very good projects when the market turns quicker than what we are in control of. So that's the case in point. So just keep that in mind as you go, right? So the second thing here, I will spend about 5 or 10 minutes or so to talk about what is it, what is capital call, and how does it typically happen, right? Now I'll try to segment it out as much as I can. So the capital call, typically when we say it's a process or an event, one general partner requests additional capital from the limited partners who have committed funds already, right? So we raise money, deal is done, we move forward, and then something happened that needed additional cash because the project itself wasn't cash flowing. Then we went back and asked them to give us some more money, keeping the same position that we have, so to dilute the position that we have. That's the definition of a capital call. So typically there are 3 buckets or 3 reasons it's going to happen. The first one is the market driven. When we make, again, when we buy assets, it's a snapshot or of a point in time where we take all the available information and forecast it out how that's going to play out, right? Sometimes the insurance cost and the tax and the interest rate, it's not in our control. We take the best case, best position from based on what we know, based on what we see, and we kind of go. I'll give you some example. It's when we bought the Pasadena property, and I come from finance, Sanjay comes from finance, Ajit is an accountant, and Mike comes from an oil and gas outside. We are macro guys. We try to look at the macroeconomic view and also make a decision, right? We modeled quite a bit, and we thought we bought the rate cap 6, and the 6% will hit now, a year from now. And because, I mean, we understood that something is going to happen because so much money came in after the COVID, inflation will go up, and it's going to go up in a steady state. It's not going to break it. Fed's not going to break it, but they are going to raise it. We just didn't know how fast. So we made a choice, modeled it out, put the cash flow in, we did everything, and we assumed that 6% will hit about 9 months out. When we bought it, it hit in less than 45 days. But we bought it at a very good basis. We had a lot of breathing room. Project paid out. We were able to recoup that interest payment. But think about $47,000 of interest payment in the first month, down they went up to 60 grand, right? It was a big hit, but the project had a lot of breathing room, had a lot of work for us to go about it and kind of pay out, and then still float that project. The project still cash flows today, right? So that's the interest rate. Sometimes it's just beyond our control. Now that's going to come into the play second go around, depending on how you make choices. And the second one is the operator driven, which is whoever's buying the property or whoever's executing, or the GP team, especially the portion of the GP team who's coming up with the business strategy and making those assumptions in the pro forma, and their capability and their capacity. Why I say the capability and capacity, because you may have heard from us talking about when we buy assets, we look at it as if we're buying a business, and we're buying a whole lot of risks, and we have to mitigate risk as much as we can. Being a CEO, running an operation of a $5 million asset, which is a company, it is dramatically different than a $20, $30 million. Somebody's doing $30, $40, $50 million deal, even $10 million deal, they should have a good idea about the market cycle, business strategy, the structured finance, how the money is flowing, what the rates and how the rates impact to the cash flow, the whole thing. Sometimes the capability and the capacity as an issue, that boils down to the assumption, boils down to the business strategy, right? Sometimes we make bad business strategy or good business strategy in a very bad market cycle. My case in point will be the Apple's way, the way they structured that, the foreclosure that they had. That was a good execution of the structuring, but it was a very bad time of the market. Less than 9 months, he's upside down, right? Less than 3 months, the whole thing, we knew the project was going upside down. So the business strategy and the market cycle, they have a very good correlation. The way we're buying now may not be good during the up cycle, right? It's just different. And the last one is the operations driven, right? That we hired the wrong property management company. We didn't know the local subculture of it. And then the phasing of the execution, that means we went in and tried to increase the CapEx, execute all the CapEx, and end up doing kind of over rehabbing the project, or we're pushing the CapEx, and we're pushing the occupancy, and we're pushing the rent growth all at the same time. That resulted in a very high vacancy that doesn't cash flow, right? So that operations driven, I think that is somewhat of a mitigatable, but that's what happens sometimes. Operator driven, that is most of the time. And then there is a market driven stuff, right? So this is the bad timing or the bad situation. There is nothing you can do. So if it is bad, if you look at a scenario where you have a project that has a capital call, really from the market driven, right? And in Houston, I know good operators, like a very good operators, and I'm comfortable to give them the money, and we did. And they bought the asset at $800 per unit, your insurance cost, that went up to $1,200, $1,300, $1,400. Now is $2,200. They are one of the best operators, one of the best operations decision, but it's the market driven, right? Happy to support them, right? Versus someone else where they don't have back offices, this is the first asset, and the assumption the pro forma was crazy, and hey, they're assuming, like I'll give an example. I saw an underwriting today. Someone is adjusting the insurance rate today, which is higher in Houston market, and they're assuming only 3% increase on the insurance to buy the asset, right? All of us, we know the insurance doesn't grow at a 3% rate. It grows at a much higher rate. And if you have 200 some odd units, that's a big cash flow, right? So this is the operator driven. And so if that's a market driven, which is okay as long as the operator are pretty good. But if that's a subpar operators at a market driven and they have a subpar operations, decisions, that's an issue. But if that's a good operator, market driven, and something happened at the property management company, but we know they're working hard, we know they have assets in the local area and they're making the right decisions. Good things happen to bad people, it's okay, right? So the whole point is, at the end of the day, in general, it will boil down to the operator. And when that happens, so as an LP, when we take a look at a project, and when we say, hey, the project is going good or bad, and take out the market, take out the operations, then you'll see the operators, and especially number 3, the capability and the capacity will shape the stage for most of the time for any project. Right, so understanding that. Now, the truth is, a lot of us, they invested with us because they know us, right? They know us as a personal level. They saw us, our historical data point, and that, right? But on that note, as you look at any project, be objective as much as you can, and let's pretend like you don't know anybody, right? You have the full slate of all the syndicating teams. Go look at it, be academic about it, do your own due diligence beyond the personality, how they connect with you, look at the capability and the capacity. And then you kind of, make a decision as you kind of go through. All right, so on that note, I think I'll pass it on to you, Jonathan, if you want to talk about the case study.
Sure. Okay. Thank you. So I'm the attorney in-house for Massive Capital. And so I need to provide, I'm not providing legal advice here. I'm sure we hear that quite often. And you are urged to consult your own independent counsel when you are reviewing operating agreements and things like that. So the typical scenario or the capital call is driven, at least from a legal standpoint, by the operating agreement itself. That will dictate what the terms are of the operating agreement or what of the capital call. And every operating agreement is different. What I'm talking about is a scenario that is used in the operating agreements that Massive Capital utilizes in most transactions. The capital call is not a requirement, it is optional. Some operators have capital calls that are required. It will depend on the transaction and the agreement itself. So if there's any doubt about it, consult the operating agreement. If there's questions or concerns, consult the operator or legal counsel for further clarification. That being said, with a capital call, it's a fairly structured scenario. And what we're going to do is go through a couple of scenarios as to how that plays out. So in the base case scenario, this is how the operation starts. You have an initial contributions of $100,000 from 4 investors. Total capital contributions are $400,000. Each of those investors has a 25% share. Now we come to a capital call, and in this scenario, we have a 10% capital call, where the manager of the syndication says we would like you to contribute 10% of your initial capital contribution to raise money for the project. So in this scenario, we have 4 investors, each of them having a 25% interest with a $100,000 capital contribution. They would be contributing 10% or $10,000. It's a small raise of $40,000. At the end of the day, their capital account has now increased by $10,000. So they've got $110,000 each in the deal, and their ownership remains unchanged at 25%. Everybody invested equally to fund the capital call, no change in ownership, and all is good at that point. Now we move to the second scenario, where we have a partially funded capital call. And again, the same scenario where we've got a 10% capital call, but only 2 investors decide to participate in the capital call. And so in this scenario, we've got investor B who decides to contribute 10,000. Investor D decides to contribute 10,000. Their capital accounts go up by the 10,000. but their ownership percentage changes. It goes up by 1% to 26%, and A and C drop down by 1% as well. Again, they weren't obligated to, at least in this scenario with our operating agreements, they're not obligated to contribute, but it does have a detrimental effect because it dilutes their interest in the transaction. This one is a partially funded capital call because you'll see there wasn't a full 10% raised. It was only $20,000. So now there's a possibility that the managers need to look for additional funds, either in the form of a loan or look outside of the current operator or current operating agreement and its investors. So now we go into the third scenario, and I've characterized this as a failed capital call and a new offering. And this can take various forms, but we're going to look at it as a failed capital call with none of the existing investors contributing money for the capital call request. So everybody stays at $100,000. But there's still the need to get those additional funds. And so there is a new offering done pursuant to the operating agreement where another investor is brought in, investor E, who is allowed to contribute $40,000. In so doing, now we have a 9% ownership interest going to investor E, and A, B, C, and D no longer have a 25% interest in the deal. They drop down to 23%. So in this scenario, and the capital call gets funded, that's a great situation, but everybody's interest has dropped down a small bit, at least in utilizing these numbers and examples. And so that's the ramifications of the capital call. There are situations, so in our agreements, essentially the opportunity to participate is voluntary. If you elect to contribute, your ownership should stay the same. It may not necessarily, but you're able to contribute on a pro rata basis. For those that don't contribute, the contributing members have the ability to make up the difference for the non-contributing members. All right, so that's one way of getting it fully funded. If we had a partial capital call, partially funded capital call, some of the other investors could come in, either B, for example, and make up the difference, and their share would increase in the overall ownership percentage of the company. And then if that doesn't work, if there's no opportunity, if there's no additional funds coming in, then the managers of the syndication have the ability to go outside of the existing investor pool and solicit contributions through another offering to bring money in to fund the transaction. The next option, if the managers elect not to do that, is to seek alternate funding in the form of a loan, either from the management team, the GP team, or a commercial loan from a third party. So that's it in terms of the numbers. And one of the things that we wanted to talk about is, what happens when a capital call occurs. Again, each deal is unique. Each deal is going to be based on, the composition of the individual investors and your ownership interest in the entity itself.
Jonathan, thank you.
You're welcome.
Thank you, Jonathan. And again, those are very simplistic base analysis to give you some idea. And then things gets complicated from that point in time, right? And then but at least from an LP investor, you should expect when you look at the PPMs in OA, you should take a look at it, whether it's a voluntary, whether that's involuntary, then we can go, right? So I know this is a very tough topic, right? It's whenever we drive a lot, potholes are gonna be there. We're gonna take a hit off it, and we try to mitigate of those, how many spares I can have. Does it make sense to have spares? And then if I have way too many spares, can I even drive my car, right? So putting everything together, we'll share with you how we take a look at it, right? For us, going back just to kind of touching base a little bit, the investment, the market, and the operator and operations, right? I'll show you how we take a look at it from the massive perspective. us, we look at, we try to understand market cycle. We don't quite know like exactly what point in time would go up and down, but we try to come up with a range, right? The coolest thing that I would say for us, we are heavy into multiple asset classes. We have data points, right? They're just saying in the residential space that you don't buy assets on a hot market to flip. It's just a bad business practice because you don't know when it's going to break. And if you get caught in the middle, you're there. So for us, we looked at the same thing. When the price was going up, we don't want to get caught with it. So for us, it's the market cycle first. And again, full disclaimer, we don't know exactly what what point of the market cycle, but we're trying to get a jive out of it. And then we take a look at the financing. And third is the project. We are not one of those teams where, hey, I have to do a value add in a class B on a 75 to 100 in a Dallas area in a certain zip code every single Monday of the year, right? We don't take a look at that way. We take a look at what my cycle is, how the market is doing, what the financing tells me, put some breathing room, then whatever the project is. And then what happens, interestingly, when a value add goes away, which is now, in a certain area, we can go to a different area. If the value add goes away, but land development makes a lot of sense, we do it. One of the things that we said that, hey, when market takes a downturn, right, land takes the biggest hit on the price. But on the upside, if you can hold the land goes up at the very tail end of it and you go. So we kind of saw that, right? We did a couple of land deals already. And then at the same time, development 2-3 years out makes a lot of sense as we wait for the value at class Cs, right? We're doing that. And financing has a lot more play to it there. And the second thing is that we want to have as many options as we can. One of the way we can add flexibility into our decisions is go wide into geographical locations and also stay across different assets. So we have different options. We don't want to be one of those teams that we have to do deals because of the points, right? We don't. We're looking for good projects and a good location on solid financing and whatever the shape stops to be. And that was one of the reasons we went to 6 markets. I remember as people are saying feedback, how are you managing 6 markets all at the same time in 3 different asset classes? Here we are. On the operations philosophy, we have a saying that we don't do any deals where collectively as a team, we don't own assets for at least 1 to 2 years. We say that's because when you buy an asset, it takes a certain type of know-how to go through 1 or 2 cycles of tax, of insurance, of property management, of troubled tenants to really say, I kind of sort of been there, right? So that was the first thing. And the second thing in operation, we always pay retail price for the third-party management company. Our belief, multifamily, it's a revenue game. It's never a cost leader game. It's a cost efficiency game. And we do that because if I did my business plan on a 3.5% management fee, if my property management 1 doesn't work, I can go to property management 2 right away. Versus when we do a business plan with the 2% property management fee, where we know,
Louisiana teenage.
Sorry, I got a body discount when I cannot change the property management company because my body discount will go away and my business plan will be a problematic thing, right? The other one is that we don't get into special type projects unless we're very extremely comfortable about the technical skills needed to execute the project. Example, we got invited into a call in Florida, Orlando, downtown, 27-story high-rise building with one of the largest private equity company in, from Florida market, Dr. Patel's private equity company. We spent, me, Sanjay, Mike, and one of our partners spent a day, worked with them. They interviewed us, we interviewed them. That was a $97 million deal, one of the best deals, beautiful deal I've seen. It takes only $3 million to raise to get into it. But we walked away because they have all the money, never owned a multifamily. We can raise, but we haven't done a high rise. And then they're hiring an asset management company, all they do high rise. So we thought it was too many new people trying to do a new thing in a new area, too risky. We walked away. And the last one is that we always manage the asset with the local asset manager. So you'll see us, almost all the projects we have done, we have boots on the ground, somebody who has checked out the number 1 already. And the last thing that is not quite spoken about for us, it's a very big deal for the liquidity and the balance sheet philosophy is that our sponsor team should have at least 2x, if not 3x of the balance sheet needed for a given project. If you buy a 6, sometimes you'll see deals, we're trying to buy a $3 million deal or $10 million deal, the sponsor team, checks out the $10 million threshold, they get the loan. For us, it needs to be 2x, if not 3x. So as of now, all the deals that we have done, that deal team that we put together, sponsor team, they have around 3x of balance sheets, including our largest deal and the McCollum one. We do that because if our team has a deeper balance sheet, that means they have been into a lot more deals and they know what the good or bad looks like. They can help us with the wisdom to make sure that the deal is in a good spot. And for us, the other one is the sponsor team must be liquid to allocate money into a deal when things go sideways. For us, multifamily is a pay-to-play game. It's an expensive, market segment. Unless our pocket can allow us to go sideways a little bit, we should not do a deal. Which is also why when we decide on a deal, we say, hey, 3 to 5 months of working capital. If something goes bad, without calling anybody else, can us, a massive team, pitch in the money for now? Which is why when Jonathan was talking about that, can the massive capital sponsor team provide some funding into the deal to float the deal 3, 6, 8 months or so without calling a capital call, without going through that nightmare of bringing everybody else in. So that's what we do. And the third thing is within our internal team commitment is if we're to get into the capital call where number 2, the liquidity and balance sheets, that our money is not enough, then we'll let go our share first, keeping the LP share constant, which is in this particular case, when the investor EU came in, that 9% comes from our general partner share, not the LP share. And then we cannot do the deal, right? So I went through rather quick. And again, this is our massive philosophy. And I'm sharing this, we are sharing this with you guys as an LP, because when you take a look at it, ask those questions, look through the team, and make better choices, right? And I'm not going to wood and pray to God. So far, we have been lucky. It's not that we're not going to make mistakes, right? As long as you make more good mistakes and less of bad mistakes, we're closer to the reality, we should be okay. And that's the premise of us sharing very tabooed information and talking about this on a hard topic as we go. I think I went over a little bit time. Back to you, Trevor. So if you want to take the questions and we go from there, time for Q&A.
Yeah, so we'll do some Q&A. And one of the things too that I want to understand, right? Even bad operators don't want to do a cash call, right? Because it's about as bad as it gets, okay? But it does happen. Obviously, it's happened. I've had 2 cash calls so far this year. And there are lots of things to consider, right? And obviously, we're trying to disclose at the beginning what our philosophy is to have some sort of comfort level. But you often don't think to ask these things in advance. And then next thing you know, you're in a situation where you do have a capital call. And if nobody participated in the capital call, nobody wanted to invest in the deal, you do run the risk that the lender may come and take back the deal, or something else may happen, because that's what can happen. Clearly they ran out of money. They've got no reserves left, and they need to build them up. And so it's a big decision to make if you get stuck in that position. So maybe if we stop sharing, we can pop it up. We do have a question. Oh, that's Maria asking a question. So this is a direct question to me that I don't know the answer, so I'm just going to say it. You did the additional raise on Pasadena. Was that part of a failed capital call?
No, on Pasadena, what we did not raise enough all the way. So we raised about almost 80% of the money because we believe that at that point in time, we believe that interest rate will come into the play about 9 months later. Then project had a busy room. We can collect the rent, we can save enough money, and we can reuse it back to the project and save as much of a GP share as we can. Then this one happened, and we started doing a lot more deals. So we took a position is that every time we do a deal, we'll fund the deal 100%, make sure the deal has a breathing room, because we're going to do a lot more drills. So short answer is no. We intentionally stopped raising all the money because we thought rest of the money we can put into the profit share, that untouched equity. So when we came together in the Q4 last year, that was because to finish the whole business plan, which is our standard practice. Anytime we have a business plan, we'll finish the raise all the way. Then we make sure the project is in a good spot. Then we go about the next project. Thank you. Very good question.
Yeah. No. And again, I know it sounds like I'm being disingenuous, but one of the things I really like about Massive Capital, we're not afraid of questions. We're not afraid of discussing the truth. We are not perfect. We pretend we are, we try to be, we work really hard to be really good, but things happen, right? This is a business world. Things happen. And so our goal is to have an open format where people get to know us, get to know our point of views. Clearly we can't advise somebody on another deal. But you know, I had 2 deals that had capital calls. And I'll be honest, on one of my deals, I said, you didn't do a big enough capital call. And they said, oh, no, we're fine. And then 3 months later, they said they didn't have enough money. And now they managed to find another source for the money. But again, it added stress to the property because it was a loan from somebody that had to be repaid, got put in position above myself as an LP. And so you want to make sure that you understand and ask proper questions. And, you know, there's always this fear, is it good money after what could be now turned into bad money? And, you know, it's just sometimes things take more money to get done because the marketplace has changed. And again, there are lots of great properties that are struggling because of what's happened in the marketplace. Increase in interest rates, increase in taxes, increase in insurance, that I'll be honest, whoever saw the biggest interest rate hike in the history of the world in a period of time would happen in our lifetime. You know, I'm old enough to remember my first mortgage was 16% on my house. So it tells you how old I am. That was a tough time. You know, but whoever heard of 2-3% interest rates and all the different things? Again, lots of different things happen. So feel free to ask questions. We want to make sure that this is an open flow. It happened in the early 80s as well. You're correct. Markets have cycles, right? And if we could all predict them, we'd be a lot wealthier than we are now. And what we do is the best we can with what data we have, right? If we had crystal balls, we probably wouldn't even be here because we'd be so rich, we'd be flying around on our private jets or whatever. I don't know what we'd be doing. Actually, I think we'd be here because we love it. But you know, it's definitely so. Feel free to ask any questions. Unmute yourself, put it in the chat. And, you know, we're not going to beat it to death. We'll give it a few more minutes. And if there's not other questions on this topic, we'll switch to any open questions. One of the things I do want to put in the chat, I mentioned before, we do have a very exciting opportunity, X-Space, coming up in Houston. Oh, there's Natasha. We'll let her do her question before I do my shameless plug.
Hi, how are you all today?
Good to see you.
Good to see you too. I was just wondering, how often do capital calls happen in general? Like maybe a percentage of times with different deals, or which asset classes?
So I don't think there is a normal. That's the one interesting thing about it. And so a lot of this is driven by the things I mentioned before. I've passively invested 21 times. I've had 2 capital calls, and they all happened basically at the same time for the same problems with the same sponsor. Deals were bought very similar time frames. They were bought with cap rate insurance that was expiring. They needed the money to get another cap rate insurance to protect more risk. So I don't think there's a normal. And again, out of 21 deals, I've had 2. You know, and I've had some big home runs as well. And I had one that didn't even do a capital call. It was just a capital loss, which is the worst that can happen, but it does happen sometimes.
Yeah, I can add some data point to it, right? I don't think so we can say what the percentage, but what we could say is that when the loans were, when the projects were purchased, right? So, you know, that any asset, most of the asset that we bought up until last year was based on the pro forma. And so in other words, 19 or 20 forward, if we bought some assets, and especially in the really, really top end of the price or deep, a value add, they would have a typical problem. a good chunk. I know one of the very good operators in Houston area. They have 17, 18 deals, and about 9 or 10 of them were purchased in the last 3 years or so. And he's holding off the dividend payment from their 1 or 2 will come to the capital call. But he was very upfront about it. He's fighting it through it, and he's gonna take the whole portfolio through the downturn and deliver the project. May not be at best that we thought it, but still he's gonna be in a positive note. It's just gonna take a little longer, deeper carve as we go. Right, so it's the time. I would say look at all the projects we invested last 2 years or so, especially those are the higher risk one. That's one way on a segmented out on the time perspective, and the other one is that 9 out of 10 times the operators are trying. I have some bad. We have seen some bad examples of it, and at the same time, very less projects are so upside down that they cannot get the money back out. Right. But usually, in general, everybody is trying their best to go through it, right? I would say dominant chunk of us, because we do care. This is other people's, and this is everybody's hard-earned money from the bank account wired to us. It's a responsibility. So, on that note, all the deals that we take a look at it, a very, very good chunk of folks are trying, busting their heads, just fighting it through as you kind of go through. So, allowing a breathing room to those set of operators is very, very helpful.
Okay, that makes sense. I just kind of compare it to like the stock market, how that like it's going to be good years, there's going to be bad years. So there's a little bit of an average that things might happen. So that's what I was kind of trying to reference it to, like maybe the average, kind of like the 2 and 21. That's a whole lot better. You'd rather have a lot better days than a handful of days that aren't as great.
100% agree. And on that note, I always talk about investment should be for ones and twos, not for the home run. If you go for the home run, that one shot that you take, it's a bad shot, you're dead, right? Trevor took 20 shots. Like he took the shots 20 times, 20 plus times now. Now it's like a 24, 25 times from their one. Versus imagine me investing in the Apple's way in the very last deal, first shot, and I'm out, right? So I always say distribute your portfolio, keep rolling it through, and by design, a dominant part will come through and some part will go sideways, which is okay. In aggregated portfolio will perform, right? From the stock perspective, I don't know how you buy it. I try to look for the arbitrage, right? As I thought I was good at it. I have Bloomberg terminal from my house. I used to do option trading, whole shebang of it. I made my money on the banking sector. I'll give you an example, Freddie and Fannie, but at the same time, Bank of Greece got me upside down pretty bad, right? So it depends on what you do, but the point is keep investing. Smaller chunks, distribute your risk out. Should be okay.
And Richard asked the question, and I actually don't know the answer because it hasn't completely happened to me. Will the capital call be reflected in the K1 for that year? And is there a modification to the original agreement? So I happened this year, so I haven't got a K1. I know there will be some sort of adjustment that will come to me, but there was no adjustment in the operating agreement because it already had provisions. What will happen if?
I can give you that for us. So again, I'm not an accountant, but I'm talking about from our experience. So we had an error in one of our K1s. And the CPA wanted some more time, and we wanted more time to correct it before we distribute to the investors, even though some of the investors needed it. But we said, no, we're going to give you a one-time right. That's because if there is a correction of any adjustment on your percentage ownership, then we have to redistribute the K1, recalculate the partnership, and change it. So yes, if your position gets diluted, then K1 has to be adjusted by it. And your CPA and or the GP team will take care of it for the given year. So I think that's what Richard was asking. Yes, and yeah. Okay, Trevor, back to you.
So we have a question from Sam in the chat. With multiple pullback, what are we looking at and decline in rents? There will be good deals, but might not make numbers. If that makes sense.
That's a slippery slope, right? One thing what we like to think is that one of the cool things about real estate, if you can wait it out a little bit, it works out. One of my good mentor, he always said, look, when a sandstorm comes, you don't fight it, you don't run away, you hunker down. Let this storm pass, you figure out your way to come back. So when I take a look at this kind of market, doing it just like that. And with the real estate, I just don't see how price is not going to go up. Now, for some of our assets, yes, we have some stagnant period, but we are turning in the corner. So some project you'll see a fundamentally wrong project. You could kind of see it. We looked at a project upside down in San Antonio area. It's been upside down for 6 or 8 months or so. It's a very good location, strong buy price, but there was some tactical error. GP team had a fallout. It's upside down. It's a total loss scenario, and it doesn't work saving the project, right? I could see some fundamental wrong with that. But the dominant part of it, it just impacted with the bridge, right? So you have to be a little bit more objective, going back to the 3 segment, right? Whether it's a market, operator, and the operations, as long as you feel comfortable with the operator, go support it. But if you don't feel the operator, go have a hard conversation and see. Another thing that I would say, look, I mean, let's say I invest $100,000. If I choose not to invest at all, that could be a total loss scenario. But if I go back in 150 grand and I get back 50% of the money back, it's still, it's a better evil to have, right? So there could be some scenario. There are some scenarios where we need to go inject some capital so we get the money back, at least 50% of the money back, not 0%, right? So that's also a case that you have to think about it. Good question. One.
So we have another one from Kathy, and it says, where are we in the market cycle and what strategies work best depending on where we are in that market cycle?
I wish I would know the answer right away. I'll give you at least. So we're in a down cycle. You know what? Let us make us feel good. We're in a down cycle. So how down it's gonna go, how deep it's gonna go, I think it's plateaued out a little bit. Right now, whoever has the holding power, they're gonna go. Right. So for us, what we saw some of them coming last year, our philosophy on a down cycle, 3 things that gotta go work on your side. One, you got to have a balance sheet, because when a down cycle, bank is gonna shrink, lending is not gonna happen. But if you don't have a strong balance sheet, you are not lendable. And if you're not lendable on a downturn, it's done. That's number 1. Number 2, if you have liquidity on top of the strong balance sheet in a downturn, we're gonna get ahead. And that's the recipe. And the third thing is, on a downturn, you build the team. So when the upside happens, your team is in the forefront of catching the upside to get more profit out of it. So that's been again, I didn't talk about the project. I talked about the strategy and what does that look like. Going back to the project itself. So we believe that the whole value add process that we had, that would be in a pause for a while. So we have to look 2, 3, 4 times deeper to find those value adds. And the value add that could happen were like not much of a value add for someone, but if you could add operational value add a little bit lower than the market expectation, then we add a little bit more financing value add. Put together, we are back to where we were. And that's a structured finance conversation. And that's a little bit more thing that we need to be very cognizant about. Going back to the balance sheets, for a $10 million deal, when let's say for a $10 million deal, when a $10 million team shows up, that's the type of conversation they will have with the lenders, versus for a $10 million deal, when a $50 million team shows up, they have a different kind of conversation, and they could extract a little bit more value in the financing end of it. Then when you take that, put it on top of the project, 2 mediocre return put together becomes a good return for the given market. So in this particular case, folks with this very strong operations, strong balance sheet, will do deals, and they're going to do still good deals compared to the market as of now.
All right.
That's a deep question, by the way.
It's very deep, but I like it. It gets the conversation going. We have one from Mohan, and Mohan understands, like you explained, when capital calls happen. But is a capital call a forewarning that something is fundamentally wrong with the project? Is it something where we could lose all of the investment? Shouldn't we clarify here what corrections are we making that they're making? That's
I
kind of a
think we
two-part.
touched it. Yeah. We touched a little bit, right? Let me use a case study. It's
Mhm.
easier to see the scenario. Let's see Apple's way. They come back and say, you know what? I have 2 foreclosures already. I lost all of your money, Shariah. I got a 3rd foreclosure coming up in 2 months. You're out of luck again. You're about to lose everything. Why don't you give me a little bit more money and see if I can give you 50% of your money back? Right? As sorry as it sounds, it is crappy. But if I would have comfortable, comfort zone that he's going to stay and work hard, and I believe he has a team. In this case, I don't. But then I would give him the money. So to save some of the money that I have into the deal, instead of getting a 0, I'll get something out of it. That's or I'll take a look at it from outside and see if I can get more return out of it. So net, if I get more money, I'm not going to do it. Right? It becomes a pure calculation, right? So think about that scenario. You have a fundamentally wrong project. You lost $100,000, and you have another 50 grand to spend. So you have 2 dramatic choices. One, give them another 50, and you hope and pray that comes back as a 75 from the total. Or you take that 50 and you say, I'm not going to give it to you, because if I give it to another team, it comes back at 100. So 150 I put in, I get back 75, but 150 I put in with the 100 loss with the 50 in, I get 100 back. I'm still in the money for the 100 back. So I would not give you the capital call. I'll give it to somebody else because I get a better return out of it. So it's a choice that we have to make. It's a tough one.
And a big thing to consider too is what communication happened coming up to it. In other words, was it a surprise? In other words, hey, listen, we're here. This is what's happening. Looking forward, if these things don't happen, we're going to run out of cash. We may need to do something. Here's our plan, why we want you to put money in and where your money's going. And then hopefully after you put your money in, you get good updates. So again, if it's a sponsor you know, like, and trust, they've been honest and forthright in giving you your updates. That's a big different factor from, wow, this is a surprise. Nobody said anything. Now it's, someone asked about cash calls in the chat, it's 10% normal. I've heard of 100%, which is not normal, but I've heard, like they're in big trouble, not in little trouble. And so you've got to make some decisions. And again, you want to be as educated as you can. Has this sponsor been transparent and open? And are they presenting a reasonable plan that you believe is worth going into and not risking losing your money? So again, people that are open, that share, that communicate goes a long way on whether you should participate or not.
Yeah, I wanted to chip in a little bit too, and it goes back to I think the first slide that you had, Schreier, because it to me it depends on the conditions. Is it a bad operator, right? Is it a market condition that is I can see the way out of it? And those are the things, as you go through that whole evaluation, right? And you guys may have been talking about that and I missed it, but I was just thinking through it, myself, and that slide is, if I know the condition, I think he, even referred to, definitely need to dig into what was the cause and what's the plan. And as Trevor said, what's been not just the communication, because anybody can communicate and hide something, right? But what appears to be the clarity of the communication and consistency of the message.
Awesome. I think we got a lot of them. Before it's 7 o'clock, I still have to do my shameless plug. So
Trevor doesn't want to let it go.
I'm super excited about our
hold on, Trevor, before you go, Carl, we're sending out an email and we switched platform. So I'll take 10 seconds real quick.
Yep.
Just for everybody else, we have done 8 deals last year. That's quite a bit of growth for us. And we are communicating some week 2 and week 3 and week 4. Finance team wasn't quite there. We are in about 4 different platforms that we raise money. So finally, we have consolidated everything into cash flow portal that we have. That's the database that we use. And we send out investor updates 3rd week, a week of the 20th of every single month. So between the 20th and the 25th cookie cutter, you get an update from us from every single deal that we do. That's now. And so for the Pasadena we are in 2 different platforms at some point. Now we have 1. And so we took out all of our investors from the TM1 database into our database now. And we are updating there as well. And we'll let out a email to all the investors by saying that please sign up at the cash flow portal. All the financials, all the updates are there for you waiting as you go. So in general, we send out updates on the week of the 20th. We have a standard format now, and all of our investors, please join on the cash flow portal. Go to our massive.capital on the top. There's a sign up page. Once you do that, you'll see your project that you have invested, plus all the projects that we have ongoing. One of the reasons we went to cash flow portal because it's transparent. You get to see all the projects that is working at the same time. So you can benchmark your all other investments plus all the other projects that we have all together. So Carl, please join there. We'll send you an email. And there's also a side email coming up to all the investors that we have. Back to you, Trevor. Sorry, I just have to give him Carl the answer.
That's okay. No, it's very important. So I put a link in the chat. We have a webinar on our X-Space land development tomorrow at 6. So again, want to invite people that are interested. It's a 506c. It is a super cool, unique project. I also included a link just to a small video that gives you like a hyper quick view of the OM and some of the aspects of it. So we'd like to invite you to come to that, if at all possible. We've all put our link and chat information. Mohan asked about seeing the Austin facility. I sent you a direct message. We're going to try to set up a tour. Our goal is not to do onesie-twosies, but try to get 2 or 3 people together. And that's also good because you can hear their questions as well. And I also have a pretty cool video that I can share on Austin, just so you can see what it's like. Let me put that in, and I'm done my shameless plugs. Sorry.
You were answering Mohan's other question then, right, Trevor?
That's correct. I sent him a link. If anybody who wants to get to see the Austin facility, feel free to reach out to me because I'm Austin based, and I can arrange it with the powers that be. And then if you're interested, just to see what the space looks like because you're not local, this is another video that shows the why is my link not working? Sorry. I'll reshare that, and then I'm done shameless plugs.
Trevor, we know you. Just because you live in Austin, you got a thing for experts. We get it. We get it. It's all good. Mike, after party is yours, big guy. Mike is like, yes.
What was that?
I said, after party is your show. We're over time.
Yeah. So I'm going to have a bad thing going forward here a bit because my call with let me see, so my Grant Cardone call weekly Wednesday has moved to 7 p.m. Central. So my weekly time with Grant now is right at the after hour party. So
ask him to join. He'll be all right.
Yeah, we should get. I don't know how we can combine the 2 meetings.
It's gonna be a massive Grant event, right?
Yes.
Sound good,
So yeah, I'm not sure how I'm gonna handle the after party going forward. So
that's fine. We got you covered. Between Maria and Trevor, they can rock the whole thing. It'll be all right.
Definitely. Well, we want to thank you all so much for being here. It was a good conversation. We had some amazing questions. Please stick around if you'd like to continue the talk. If not, thank you so much.